so we'll go ahead and get started. Welcome to today's webinar on planning for long-term care. My name is Jennifer Markowski. I'm the COO and Marketing Director here at M Financial Planning Services. And we're going to discuss why long-term care is an important part of your financial and family planning. So let's dive in. I will first introduce Ed Garudo, a certified financial planner and financial advisor with us here at M Financial, to start us off with the first part of the presentation.
Right, thank you, Jennifer. Well, long-term care is a financial issue, and statistics tell us that 70% of folks who achieve age 65 will need some form of long-term care during their lifetime. And it's costly. The lifetime cost today is really around $172,000 per person, or $344,000 a person. And health insurance and disability insurance do not cover long-term care needs. So anyway, it's something to really think about. Next slide, please, Jennifer. And just to give some perspective on that, we have these charts that show the odds of your needing long-term care. And you can see that the odds of a house fire are 1.2 in 1,200. Odds of your car being totaled, about 4 in 1,200. Odds of being hospitalized are 65 in 1,200, but your odds of needing long-term care are about 840 in 1,200. So it really is a important thing to plan for, important thing to consider as you're doing your planning. Next slide, please, Jennifer. And long-term care is really a family issue, because not only is it the affected adult, but 83% of care that's provided to older adults is delivered by friends or family members. And so 70% of those caregivers may suffer a work-related difficulties due to their caregiving duties. 20% of full-time employees can lose up to 10 hours per week during working hours to help an aging loved one. So by planning and taking this into consideration, you can be reducing the caregiving burden on your family. Okay, next slide, Jennifer. So, of course, it's a growing issue because Americans are aging. And we certainly expect to see an increase in the number of folks who are 84% increase in the number of folks who are 65 by 2050 to 87.9 million Americans. And we actually expect to see about a 200% increase in the number of folks who will reach age 85, 18.9 million Americans. So a lot of people are going to be in a position where they're going to need some type of long-term care. Next slide, please. And of course, as you are doing planning for an unexpected health event, or outliving your income, or maybe passing away financially unprepared, long-term care insurance can actually offset some of these risks of each of these categories. So with that, I'm going to turn it over to Anthony, and he'll take it from here.
All right, thanks, Ed, and thank you to everyone for joining us today. So obviously, as financial advisors, the unfortunate side of our world is seeing this long-term care event happen. Unfortunately, many of our clients, I know I've personally experienced it in my own family. So really our goal today is just to make sure we give a really good overview of the costs associated, the probability that we see in today's world of it occurring, and really also too, just better understanding, what is long-term care. So I wanted to use this slide here just to kind of better understand the types of events that could cause a long-term care need. So you can see, obviously, it's not only due to the typical diseases or illnesses that we see due to aging, but it also be something as like a head injury that could cause long-term care to a younger individual as well. Of course, things like stroke, cancer, Parkinson's disease, heart disease, multiple sclerosis, Alzheimer's and dementia are major issues that we see typically occurring as well. But understanding, what can cause a long-term care event, understanding honestly your own medical background, your own medical history, can always be very important as well when it comes to long-term care and planning for long-term care in your own financial plan. So wanted to cover that. Jen, if we can go to the next slide. We have something pretty important here that can cover really what we see. I think on average, most of the our advisors here would say on average, when you talk to a financial advisor, will likely say what we see for long-term care events is lasting about 3 years. That's when we do financial planning. We'll typically average that cost out for about 3 years. But as this slide can even show you, 1 in every 5 people ages 65 and up, will need long-term care for even longer than that average of 3 years, and even more about 5 years. Typically, though, what we see, with this care, and I can actually appreciate this slide even more. This was my grandmother's situation a while back, and seeing her transition between the types of care. Usually, people want to and prefer to be in their own home. Ideally getting care received in their own home in the comfort of their own home. And that's typically where it will start. But maybe as the deterioration progresses, you have to move into an assisted living facility and then eventually even into a nursing home. And as you can expect, the cost can rise pretty dramatically as you go up the Richter scale in the types of care given here. So if we go to the next slide, this is actually kind of give you, I know most of us are up here, obviously, in the Northeast, but we do work with clients all over the country. Just to give some perspective on cost by state. We have the unfortunate side of things being up in the Northeast where things are typically more expensive. Same is true for medical care. On average, we see medical care in New Jersey, for example, ranging between about $135,000 to $155,000 per year. So the cost can be pretty drastic. And if it's not planned appropriately, and there are many ways to plan for this, and obviously we would hope your financial advisor is covering this with you. But something that definitely needs to be incorporated into your retirement plan. If you're age 55 and older, it should be, at least a starting point in the conversation. We'll talk a lot to our clients about that being kind of the sweet spot to begin looking at long-term care insurance from a premium cost perspective as well. And really making sure that if you are going to self-insure, you have the appropriate funds available as well here. So understanding the costs associated with it is critical. And knowing that, as you get that private nursing home care, the cost can get really drastic and go up compared to what we see as in-home care too. I'll say though, one thing, if we go to the next slide here, Jen, one thing we see a lot of, and we get asked a lot about is, Medicare, right? And oh, well, Medicare will cover my costs. And, if I have an event, I hear the horrible saying all the time is I'll just pull the trigger, right? And it's not so easy, right? Of course, when the event actually occurs and, you have family that care for you and want you to be healthy and live a long and happy life. What we see, though, a lot of the times in misunderstanding with long-term care and the coverage that you might be afforded through Medicare is very de minimis. You're going to see right here on this chart, nursing home care, for example, Medicare will pay the first 20 days in full while you're hospitalized for at least 3 consecutive days in a Medicare-approved skilled nursing facility, right? Now, the next 21 to 100 days, it may pay the difference between the total care, but it's a significant co-payment that you'll continue to need to pay for that skilled nursing care. And then after 100 days, it's not going to pay any of it. So just going back to what I was mentioning about the typical length in the typical period of long-term care coverage needed being, on average about 3 years. Obviously, you can see pretty quickly Medicare is not going to foot much of this bill at all. And then as we go into more in-depth care, you're going to see the assisted living not going to pay for it at all. Continuing care in a retirement community, not going to get any coverage there. Adult day services, not going to get any coverage. And then the home health care, you're going to be limited as well. You get some of the private Medigap insurance coverage, which might give you some coverage in a nursing home facility from days 21 to 80. But then as you go up as well in coverage, you're not going to get much coverage again there. The bigger thing that we always talk to clients about too is the Medicaid side. As I think my father can attest to, as Ed can attest to, you don't really want to be qualifying for Medicaid, right? That means you're typically financially insolvent. It means you have about $2,000 or less to your name in assets. Not a very good situation to be in the first place, but that's really the only way you're going to qualify for Medicaid. And I can say from experience, the other big thing you need to understand is that when you are under the qualification of Medicaid, you are at their mercy of them choosing where you're going to be living, right? What type of care you're going to be receiving. And to be very frank with you, in our own, experiences of seeing this firsthand, that can really be detrimental to the care that person receives longer term. So things about this, understanding what you're going to have to cover in this type of care and why long-term care insurance can be a buffer here, wanted to make sure we have a really good understanding of it. So if we go to the next slide, we'll kind of cover, why it's so important to plan now. The long-term care insurance planning will help foot a lot of this bill. Now, you have different premiums. It is very important that every situation is different for every client. We talk about the different types of healthcare, acute and long-term, is front of mind for a lot of clients today. That's why I think we have a good showing here today in today's webinar for a lot of our clients. But also, too, one of the biggest things, when we talk about self-insurance, needing to have the appropriate asset base for that. If you're limited on the portfolio assets you have when you retire, the down drag on your portfolio and having to spend down much quicker and withdrawing $155,000 extra dollars on top of all of the additional costs that you're still going to have outside, right? If you have a family member that still lives at home, he or she is still going to have those costs. And then it's a plus with your long-term care coverage costs needing as well. So what I always try to make sure we provide is also understanding how the market can play a big factor into this. So God forbid we have one of those bad timing events. You have a long-term care event, you have great portfolio assets built up, we think we're going through a self-insurance plan, and then we go through an economic recession, market down drag. Market's down for 25% first year, next year it's down 10%. Finally recovers, but we now have to make up a 35% loss in your portfolio. All the while, you are having to realize those losses because you're pulling extra money from that portfolio and withdrawing at a much higher withdrawal rate, and then when we see be reasonable. Even if you recover from this long-term care event, the unfortunate side of that might be a complete detriment to your retirement plan longer term, and the worry then would be outliving your retirement funds and potentially having to completely change your retirement plan overall. So lots of things to consider here, but it should absolutely be an essential piece in any retirement plan and a comprehensive financial plan that's built out for you. I'm going to go ahead and turn it over to my father, Ted Massaro, who's going to cover some of the next slides here.
Thank you, Anthony, and thank you everyone for joining us today. Obviously, I'm going to start off with a few questions that are sort of bullet points that a lot of clients ask. But I want to, before I do that, I want to preface it by saying right now I have 6 clients in some form of long-term care status. They're either, 2 are in a brain center. Unfortunately, the cost of those facilities are, as you can imagine, are extremely costly. One individual is not even 74 years old. She deteriorated quickly at starting at age 72, and sadly is in a state now where she has no ability to care for herself any time of the day in any way, shape, or form. And the same goes with another individual. And this individual has been in a brain center now for almost 8 years. Fortunately, the long-term care insurance she obtained from us better part of 15, 18 years ago was an unlimited benefit. And the positive side is the contract will never exhaust itself. So fortunately, the carrier's been paying a fairly substantial amount of money for a large number of years. So first question we have here is, where are the long-term care services provided? As was previously discussed, the first and preferred method is home. Everyone wants to stay home. And quite frankly, the insurance companies would prefer you stay home because they know statistically you have a far greater probability of recovery in a home setting than you do in most other settings. Obviously, if the nature of your long-term care issue is more severe, you may have to move up to an assisted living facility. Again, that requires a greater expense, more tentative care. And then, of course, if you're, depending on the level of your assisted living, you may need special needs care within that assisted living facility. Because there are some facilities in the area here, for example, that depending on your level of mobility or your ability to take care of yourself determines how much long-term care you're being provided and the costs associated with that. And then lastly, of course, is the nursing home level. A nursing home level, of course, would include a brain center. Unfortunately, as more individuals age, dementia and or Alzheimer's is becoming a greater occurrence, and those facilities can cost an extremely high premium to the other types of care you can get at home. What effect could long-term care have on families? I can tell you again, a lot of people, we call them the betweeners. They are raising children and they also have elderly parents. And so they're caught in between two generations. Unfortunately, that situation can create a lot of problems because they have to obviously take care of their immediate family, but they also have demands on their taking care of their elderly parents or parents. Hopefully the situation is a team event. If it's a one person event, there's a high percentage of individuals, especially females, that have had to retire from their careers to literally stay home in a long-term care setting to take care of a family member. What could long-term care cost? I think we've kind of approached that subject already, but it can range from home care running from 25 to 35, 45,000 a year. Again, depending on the level of the care at the house, to all the way up to 150,000 a year at a very expanded home, assisted living or brain center. What are my options if I need to pay for long-term care insurance? Well, if you have options, if you don't have long-term care insurance, of course, you have to pay from it whatever resources you have available to you. That would include, of course, your retirement assets and your personal savings. We've had situations where individuals had to take and did a reverse mortgage and to cover the cost of long-term care for a family member that no longer could be in a home setting. What are the requirements to qualify for long-term care insurance? None of us probably are in this presentation today are 25 or 30. And most of us know that as we age, the requirements to qualify for long-term care is going to diminish. That is, the ability to qualify for long-term care becomes more challenging as we age because, of course, we have more health issues that may disqualify you for the eligibility of long-term care insurance. So we would encourage individuals that are in their mid to late 50s, early 60s, if you're still in very good health or even in average health, you best assured look at the options available to you today rather than trying to defer that to a later date, because the possibility of not being able to qualify is very high. I just want to mention too, there was a brief discussion about the some individuals do what's called Medicaid planning, and where you'll work with a law firm that does put you in a status where you eventually become financially destitute. And to do that requires you to have a large amount, well, basically all your assets out of your title to be eligible for Medicaid. But there's a lot of qualifications, requirements to qualify for that. And then there's also a Medicaid clawback penalty. The Medicaid clawback penalty, as the name implies, means that if they are in reviewing the amount of benefits they pay, if it occurred over a certain period of time that you had transferred assets out of your name, they have the right to go after the assets that you transferred out and claw them back to repay Medicaid. Next slide, please. So when we look at this, we have to think about, we all have different types of insurances to protect ourselves. Obviously, our first and probably our most important is health insurance. We all know the value of health insurance, mostly to cover the catastrophic or serious illnesses, not so much for the day-to-day health issues. And we would never want to be without health insurance for obvious reasons. Auto insurance. Auto insurance is mandated in most states, but again, most individuals would never go without auto insurance. We have unfortunately live in a very litigious society, so the potential to be sued and lose a high percentage of your assets is also a reason to have auto insurance. Life and disability insurance. Life and disability insurance are obvious types of insurance that provide liquidity in the event of disability and or at death. These types of insurances, though, do not pay for long-term care, with one exception, which we'll get into in a couple of minutes here, relative to certain types of life insurance. Homeowners insurance, for those of you that own a home, I don't think any of you would think twice about having homeowners insurance, except the probability of ever having a homeowner's claim is probably about 1 in 16. Obviously, there are certain exceptions depending on where your home is located, but the probability of a claim for your home is considerably lower than probability of a long-term care claim. Of course, retirement is the reason you're looking at long-term care insurance. Another way I look at long-term care insurance, it's homeowners insurance on your net worth. That is, it's protecting your liquid assets that you have built up over the years and really are going to take care of your retirement planning. Next slide, please. When you're doing long-term care planning, what we generally work with individual clients, we first help them to understand why they may need or what's the risk relative to their personal situation. And that is probably the most important thing, is that long-term care insurance is a customized planning insurance product. You don't want to go out and just get a standardized product that your friend or neighbor has because they said it's very cost effective. You want to look at the type of product that's going to provide you what you and your family may need. The next thing we do is we develop a strategy to offset the risk. What's the probability of a family issue in long-term care? That is, do we have a health issue within the family that increases the probability that there could be a long-term care claim? What strategy is available if there is no family members available to support you in a long-term care situation? So again, what you're doing is you're developing a strategy to say, okay, where are the resources going to come from? And do I have sufficient assets to support that? Or am I going to look at long-term care insurance as a way to supplement that? And then, of course, in implementation, we're looking at the various types of long-term care planning, whether or not self-funding is an option. And again, I would say to you that self-funding can be an option only if you have what I consider to be more than above average assets to support that. If you had the unfortunate consequences of a long-term care claim costing you $60, $100, $60, $75, or $100,000 a year, that could, on a portfolio of $2 million, be taking pretty much everything the portfolio is earning. So you would then be depleting your portfolio at a fairly accelerated rate, because you obviously still have all the other expenses of your other family members that still need money from that portfolio. So self-funding is not something to take mildly. It's something we look at. We always try to explain the trade-offs of considering that option. And then the caregiving plan. Who would step in? If, for example, I have an 91-year-old client who's now moving into a assisted living facility. Fortunately, she had 5 adult children, three of who are local. So they were able to share the burden of taking care of this individual till she finally accepted the fact that she could no longer be on her own. But they were quite relieved when she finally agreed to move into an assisted living facility. And again, I just want to emphasize for those that are what I call betweeners, where you have elderly parents, one of the most challenging issues you'll deal with is that when individuals get to an older age, they can get a little bit more defiant and more obstinate in making changes. So you want to have these conversations a little earlier with your parents if you're in that situation where you could be the one that they're going to come to if there's a caregiving issue. Next slide, please. So let's talk about where the pool of benefit dollars go for long-term care. And that's basically how long-term care works. It's a pool of money. It can be used to basically provide for home care, assisted living care. Care coordination services is basically where the insurance company steps in to help identify this facility or resources that you're going to need, whether you're going to need special equipment at your home, or whether you're going to need a certain type of assisted living facility to make sure that you have the bed available to you if and when it's needed. And of course, nursing facility care is the most extreme costly. Again, it's not something I would encourage you to defer until you're at an older age. Next slide, please. So I'm going to briefly talk about the types of long-term care products that are available today. Again, each individual should look at it on their own individual basis, because what product may work best for you may not work appropriately for another individual. There is the traditional long-term care insurance. I use that. It's like a typical car insurance. As long as you pay a premium, you're provided a benefit. Long-term care insurance in this type of product does have the potential for premium increases. It does also, though, provide inflation protection. It provides other benefits that may not be available in some of the other products we're going to talk about in a minute. It does have a limited tax deductibility opportunity. Because the government knows that Medicare is not going to pay for long-term care insurance, the long-term care expense. Depending on your age, you are entitled to a tax deduction. However, under current tax law, you have to look at the fact that you may not be following the necessary schedules to qualify for that tax deductible expense. The other thing to look at too is in a business owner situation, there may be a little bit more flexibility that if you're self-employed or own a business, you may be able to use your employer-based company to cover these type of benefits on a group level. As I said before, premiums they're not guaranteed. The benefit is a use it or lose it, meaning that if you never use the benefit, just like your car insurance or your homeowners, You pay premiums, but you never collect any money back in return for the premiums you paid over all the years. Life and long-term care hybrid. This is a variation of traditional long-term care insurance. It provides similar benefit levels. However, it also provides some unique features in that, number one, the premiums are guaranteed. They can be guaranteed for 2 individuals simultaneously. There is the potential for a return of premiums if someone decides that they may not want the coverage later on. They will receive a certain portion of their benefits back. There is also the fact that you will get some tax advantage if you're a business owner, that you can use this type of products. It generally costs more than traditional long-term care insurance, but some of our clients have found this to be a more attractive structure. The other thing too is you can set it up so it has a limited payment period. So you can have a payment period of 7 or 10 years, and then there's no further premium costs for the rest of life. So for some individuals, that's a very attractive feature in planning out their retirement and reducing their insurance expense in retirement. Life insurance with riders. Basically, this is a life insurance contract that has a benefit attached to it that says that if you have a long-term care event, the life insurance benefit becomes now a long-term care benefit. The benefits are based on a period of time that they would be paid. The other attraction to this benefit is that if the long-term care is never used, there will be a death benefit, of course, paid at your passing. So this is not a use it or lose it. Someone is going to collect either during your lifetime in a long-term care setting and or at your death, the benefits would be paid as life insurance. Most times, there is no inflation protection in this type of contract. There's no return of premium, but the benefits are triggered the same way the other types of long-term care products that are available. You also have certain annuity products today where they'll have a long-term care rider built into the annuity contract. Under this scenario, if you set up an annuity contract that has an income benefit, it's not uncommon that there may be an income benefit that increases substantially if you have a long-term care claim. For example, one carrier that we know of, the long-term care benefit is double the income benefit the individual receives if they have a long-term care benefit, provided the contract has not been in, provided the contract has been in place for at least 2 years. The other thing to consider too is that if you have some old annuity contracts that you aren't anticipating using in your lifetime for income, you can do what's called a 1035 exchange, and that'll provide you the same continued tax deferred growth, but it'll also allow you to now have a contract that would have a long-term care benefit as part of that. You can do that in a similar form with life insurance. If you have cash value life insurance that you feel you're not going to need the cash value life insurance in the same way, there are certain rules and guidelines you can follow to make what's called an exchange to a carrier that gives you the life insurance with a long-term care rider. Remember this though, each of these products will require some medical qualification. So again, I would emphasize the younger you are, the healthier you are, the more appropriate time to be looking at this rather than deferring it to a later age. With that, I think we're going to open it to questions. Jennifer, I think is on the next slide. So I just want to again thank you for all attending today. We'll send this replay out to each of you that have attended. If any of you have questions at this time, we're welcome to address those for anyone that has any specific questions that they may want to address specifically. You'll have our emails that you can email us directly as well. Jennifer?
Thank you, Ted. Just as a reminder for the attendees, you can either use the Q&A box to pop a question in for us, or you can raise your hand and I'll be able to open up your line so that you can ask the question live. But that said, this is such a personal situation. Of course, if you would like to speak to your advisor, you know, in the future, personally, absolutely, we are here to speak to you about how this would affect your individual financial plan. Some questions that came up, Ted, you spoke about, for example, one client who was lucky enough to get an unlimited benefit policy back, 15, almost 20 years ago. Can you talk a little bit about how the carrier situation has changed since long-term care and the need for it have grown so much in the past few years?
Yeah, unfortunately, long-term care, unlimited long-term care benefits is no longer available. Probably the most extended benefit period you can get today is 3, 5, or 7 years. That is probably the longest you can get a benefit qualification period. One of the sad facts is the insurance carriers, when they first started writing long-term care insurance about 25 years ago, they definitely mispriced the product for a number of reasons. They didn't realize how many claims they were going to experience. As we live longer, the probability of claims goes up. And also, one of the things that insurance carriers price in their product is the number of people that will drop their insurance. This is one of the least dropped or terminated products in the marketplace today. So insurance carriers now have a greater exposure than they thought they would have. And then, of course, over the last 10 years, you may recall that we had incredibly low interest rates. That was great if you were getting a mortgage, but it was horrible if you're trying to make investment income on your portfolio. And insurance companies were definitely adversely impacted by those extremely low interest rates. So they have changed their product and pricing structure dramatically over the last 5, 8 years now.
No, thank you. A couple other questions, and these are open for anyone. Something we didn't discuss was the exact sort of medical conditions that would trigger a long-term care filing, and I know them as the 6 activities of daily living. Is there someone who'd be able to run through those briefly, or I'm happy to pull them up and discuss?
Ed, Anthony, you want to jump in? Or not? So it's toileting, bathing, transferring, feeding, toileting, bathing, feeding,
Dressing.
I'm sorry?
Dressing and mobility.
And yes, so, and then of course, there's also cognitive. That's a separate qualification. And basically the qualification to be eligible for claim is your doctor has to attest to the fact that you are unable to do 2 of those 6 activities of daily living. All long-term care and contracts issued today have federal guidelines that require that they have the same rules with regard to eligibility for claim.
I think it's so important. So many of us in the office have personal experience with this, and I'm sure most of our clients do as well. So this is more of a soft skills question, because I am that in-between generation who is taking care of my children and, starting to see my aging parents, encountering some health challenges. How would you start this conversation with your parents or maybe grandparents if if there is no plan in place, or you don't know of a plan in place?
I think I can take it maybe from a younger perspective. It's obviously a tough subject in general to talk about, but at least approaching the question from just a estate planning perspective, I think is usually a good start. We have the family love letter that we provide to a lot of our clients. And it's something that I give a lot to my younger clients, the 45, 50 years old, to kind of approach that subject. And it covers a lot of different aspects, not just only about, hey, what's your long-term care plan? Not to get too far into the weeds just on that, but also, where are your passwords saved and little things like that. do you have a will set up? And if so, do you have a power of attorney, and who is that? These are things that I think in a lot of respects, parents would appreciate the conversation on, to start thinking about, well, gosh forbid, if something does happen to me, who is there to kind of direct the care that's being given to me. And when you kind of put it in that context, I think it helps start that conversation. And then, as I mentioned, the family love letter, something that can kind of help guide that conversation too, for people trying to have this, conversation with their elderly parents.
Sure. And what I appreciate most about those kinds of documents, and of course having a plan in place, is that you don't have to make those decisions on the most stressful day of your life.
Right.
A loved one goes into the hospital and suddenly you're having to make some very serious decisions. And if they are made somewhat in advance in coordination with the family, then it really is a gift to yourself and your family to make sure that these things go as planned, and with as little stress as possible. Any other questions from the attendees?
I just mentioned one other thing too, with if you are in a situation where you have elderly parents, hopefully they're still very, very cognizant and aware of their surroundings and so forth. If you can relate a story to them that they can relate to, whether it's a neighbor, another family member that has gone through the situation, then they may better appreciate why you're having this conversation with them. If you go in and just say, well, you got to show me all your financial situation, I got to better understand what's going on. I don't want to be caught with dealing with this after you become ill. That's not going to go over very well. But if you have the opportunity to say, well, when Uncle Joe had a stroke, and you remember what happened to his family, they lost their house, or they basically became financially destitute, or whatever the situation is, people always can relate to a real life story much better than you trying to tell them, well, this is what you need to do based on some assumption.
Sure.
So
Yeah.
that's the only thing I would suggest in that regard.
Great. I think that wraps us up for today. We will be sending a recording out for everyone, and we'll also send some informational pieces, some more details about long-term care. But of course, we encourage you to reach out to our office, reach out to your advisor if you'd like to have a more personal conversation. Thank you so much for joining us today, and thank you for Ed, Anthony, and Ted for presenting. And we appreciate you and hope you have a great holiday season. Thank you.
Thank you.
Thank you.
Thank you.